This is the Mooncast.
So, welcome to the Mooncast, man.
Amazing. Thank you.
Yeah,
Great to be here.
yeah. No, I'm glad that you came. Just took time out of your day to come. It's really nice of you. And can you just a little bit introduce yourself a little bit to the audience? Just let them know who
Yeah,
you are. Yeah, and what you do.
absolutely. Yeah. So I am an early stage capital raising expert. I've been in this space for about 4 years now. I'm working for Block Dojo, which is an early stage blockchain slash Web3 startup incubator, where we work with founders at an idea stage to help them become more investable and accumulate enough growth and traction to raise their first ever pre-seed checks. And what I am doing in addition to that is that I also launched my own Discord community, which is more stage agnostic, pre-seed, seed. We got some Series A founders where we share helpful resources and everything related to becoming more investable for the founders. So it is busy days, but it's all basically in the theme of helping founders to raise capital better.
Nice. Can you break down a little bit the difference between for the audience, like between pre-seed versus seed versus Series A and so on?
Absolutely. Yeah. So the best way of looking at it is the stage of the development of your product. At pre-seed, you usually have a prototype or a very basic MVP. You are likely not to have any clients yet. You could have a wait list. But the likelihood is there's not that much traction there yet. At a seed stage, this is usually where you will have either a strong MVP built out already, or you have launched in beta and you are testing the product. You might also have a couple of clients. Many of the startups that I know, they usually reach the revenue generation point somewhere alongside their seed stage of raising. And then Series A is when you reach your product market fit. So that is really when you are finding out what works for your company and what doesn't. You are doubling down on the features that your users want, and you are removing the ones that are not met with much enthusiasm. And then Series B, C, and beyond is all about growth, expanding to new markets, growing your revenues, like doubling or tripling growth in users. And this is where it gets tricky usually, because whatever investment you secure at Series A, the investors will expect of you that you will continue growing at that faster rate and faster pace. And then what happens if a year like 2022 happens, when it's like a slowdown in the markets, and suddenly like what we've seen last year is that some of those high growth startups that really shot up in 2021, they were then no longer able to deliver the same rate of growth in 2022 and 23.
Mhm.
So yeah, that's where things get real in Series A and Series B.
Can you break down a little bit sort of the amount of capital in terms of the range you usually are able typically to raise from a pre-seed to all the way to like a Series A and Series B
Yeah,
and so on?
absolutely. So in the UK at pre-seed, you are generally looking to raise from about 250K to about 500K. 250K is the most popular bracket because this is still at the SEIS limit, which is one of the tax incentives for the early stage investors. It allows them to claim back, half of their investment back, which is a significant incentive to invest. I angel invested in one of the companies, and like when I'm doing my taxes with HMRC, I will be getting 50% of my money back from the government as an investor.
Wow.
Yeah. So all of the startups in the UK, they are SEIS and EIS eligible for that reason. So
Mhm.
yeah, to those founders who are thinking to raise in that region, this is a must. And then when you reach the seed level, this is usually when we get closer to a 1 million raise category. 1 million, 2 million, very strongly dependent on your industry as well. If you are working in a capital intensive industry, if you are in biotech, medical devices, and health tech, then those raises could be higher. And this is very much justified because of the higher barriers to entry and higher startup costs. So I have seen, let's say, a biotech startup raising about 5 million seed funding. Or, like in the bull market 2021, we've even had like 10 million seed raises. If we're talking about, the most popular startups like software, fintech, and SaaS, I would say it's closer to 1 million to 2 million. Then when we go up to Series A, this is closer to a vicinity from about 7 million to sometimes even up to 15, I would say. And in Series B, about 30 and more, maybe 50. And then Series C and D, that's where the numbers really increase exponentially and they can get really, really big. But that very much depends on your revenues, the company's traction, the company size, and their financial needs at this point.
That Series C and D it usually goes alongside with like going IPO, right?
Correct. Yes. Yeah. So I think the most typical scenario for startups is that they raise between 4 and 5 raises before the exit. So if they've got 5 raises, the last one would be Series C. And then you IPO, or then you might get acquired, you might get, a sale offer. I've heard of startups that received a sale offer at Series A level. And you can accept it if you want to exit as a founder, or you can choose to keep on growing and respectfully decline the offer. It's all up to the founder, but like I've seen exits happen as early as Series A.
Wow. When you speak about the exits, how does that actually work in regards to that? So is it just the founder takes his percentage of shares and then he sells them off, or is it an acquisition that happens and a complete turnover of the entire company? How does it actually work?
It depends. So this is a little bit outside of my main area of expertise and going more into the M&A space. But you could have an offer where the entire company is bought out. And that means that the company that wants to purchase your company, they have to buy off all of the existing shareholders' shares. And that is usually included in that sale price. So I think it was Figma that got purchased by Adobe, and that was for like an insanely high number. I don't want to mess this up so that I don't say the wrong number, but let me just quickly look it up. 20 billion. Figma exited for 20 billion, and that was one of the highest exits from last year, which was still in the down market. So very, very impressive. And if I'm not mistaken, however, do fact check me on this. I think this was the example of like a total full sale of the company where all of the shareholders got bought out.
Yeah, it's interesting because I'm looking to, obviously build listenable. And yeah, I'm always kind of curious to see how that process goes from, okay, you've raised now, you're at the Series A level, you've shown a proven product market fit, you're getting traction, you have clients. And how does that work? Is it just, okay, I want to share my shares in the open market? Also, I wanted to ask you too as well, what about when you say, for instance, you want to tokenize your product, right? How does that work? Is it the shares? Is it the same sort of level of splits from the company shares to the tokens, or is it something completely different? How does that exactly work? I don't know if you're a little bit familiar with that type of process.
Not so much, again, outside of the area of equity raising, which is my expertise, but from the startups that I've seen raising, usually the token raises could happen alongside raising equity through company shares. In some other instances, they choose to attach it to the shares as well, so to act as an additional incentive.
Okay.
So I think there's this dual opportunity here. It's definitely an exciting area for founders to explore. What I've seen, however, is that if you are raising from a more generalist VC, so let's say Index Partners, who are specializing in marketplaces, or let's say Sequoia, who are one of the biggest VC investors worldwide, quite sector agnostic. Depending on which partner you speak to, the ICOs and token raises are still relatively a new investment vehicle. And, for people who do not fully understand blockchain and tokens and crypto, if they put it into that one single category of crypto, they could be a little bit apprehensive because they are looking at the consumer crypto markets and they are, judging on what was happening there. However, if you are speaking to more specialist funds, those that invest in Web3 infrastructure, blockchain infrastructure, and they've got more technical knowledge here, you will have a much, much, much easier time raising tokens with them, rather than aiming for, for more generalist funds who might not have the expertise in that area and not fully understand, the benefits, but also the risks that might come with it.
Yeah. Would you say UK is more regulatory friendly in that regard?
Yes, and there are some positive changes happening in that space as well. Last year with Block Dojo, we were attending the London Blockchain Week. Rishi Sunak was speaking as well, and he was outlining the plans for the UK to, really go more into the areas of blockchain and AI, and providing a safer regulatory environment for this one as well. I think the most blockchain friendly, crypto friendly economies that are out there would be probably Latin America, and then Africa as well. And with the inflation that is so super high in those countries over there, it makes so much sense. And I know that because of the inflation, people were saying, I've got a friend who's from Brazil, and she was saying that a lot of people in her country, they say that it actually does not make sense for us to hold money in our own currency, because it gets devalued so quickly.
Yes.
So yes, they are looking for ways to hold money abroad or in crypto where, it's not subject to this much fluctuation.
Yeah, it's a very interesting point about the hyperinflation, because when you think about someone who's maybe working a 9 to 5 and they're getting their paycheck at the end of the month, when you're dealing with hyperinflation, your currency is, inflating at usually a 10% or higher rate per month.
Yeah,
So imagine that you get, let's say, $1,000 check as this example. By the end of the month, that $1,000 is now worth $900 in terms of purchasing power that you
exactly.
have. So
Exactly.
yeah, it definitely makes sense to store some of that value in, a really hyper intensive investment vehicle like, Bitcoin, for instance, or something like that. But yeah, I wanted to ask you about the different sort of factors that you guys take into account when evaluating these startups. What are some of like the main points that you guys look towards when you're evaluating them to decide who's good enough for the program?
Yeah, absolutely. So the methodology that we use during our investment committees is also very similar to what a lot of early stage VCs are using in their investment meetings when they are talking to prospective startups. And at the early stages, as early as pre-seed, the element that comes to the forefront of discussions is the team and the founder themselves. It has double the weight than any other factor at this stage. So this is usually what I like to call this is the founder market fit. So we want to make sure that the founder, do they have previous experience from the sector in which they are operating? Have they experienced the pain points themselves? Do they have any relevant networks that can help them launch the product that they're building? And what is their understanding of the dynamics in this market? Then we also look at the market size. And the market size, so your TAM, SAM, and so on, this is especially important if you are planning to raise capital from VCs. Angel investors might, this is more patient capital, and they might be looking for a lesser scale returns compared to the VCs. But if you if you are raising from VCs, they are always trying to make exponential returns on every single investment, because chances are in a single fund, let's say we've got 20 investments in a single fund, chances are only one or two of them would achieve the unicorn status, and only one or two of them would drive the performance of the entire fund and lift it from the underperformance in which some of the other portfolio startups might have drove them in. So it also goes without saying that, like if a fund is not performing well, it will be a bigger pressure on them to find that next unicorn that will literally save their fund performance. So that means that VCs will be looking for, huge returns. They would usually want you to address a market that is, measured in billions. You can find that in fintech. I think you can more increasingly find it now in DeFi as well. And enterprise software, for example, it's one of the VC's favorite. Health tech more recently as well. Health tech is growing very, very quickly. So yeah, the VCs are looking for that. Then we also assess the business model and revenue streams. We want to make sure that it is well thought out. We want to make sure that it makes sense. We also want to ensure that comparing how many people are on the team and how many revenue streams you intend to implement, it's crucial, because if you've got a solo founder and they want to implement 4 revenue streams, it could be a red flag. In my opinion, at those early stages, you only have 24 hours in your day. You really should pick one revenue stream which you're going to focus on and which will bring you most of the revenues. And then when you make some key hires, when your team expands, that's when you have the people and the resources and the time to launch additional revenue streams. Because it takes a lot. If you are building out a B2B whole side of the business, and then you want to also build out B2C, it honestly will feel like you're building 2 businesses at the same time. Yeah. So
absolutely.
Exactly. And one of the good pieces of advice that I can give as well is that if you only start with one of them, let's say you're starting with B2B, and you build it out, you get some customers and so on. By the time you reach your next raise, so let's say at the seed level you are building your B2B. Let's say you are preparing to raise your Series A, and you've only been known as a B2B company. If at your Series A raise, you can then make a big splash announcement that you are now opening an entire B2C stream, which will allow you to triple your revenues and open up this whole new space for your business to grow, it can actually command a higher valuation. Because you will be able to justify it better. Well, we are just about to open a whole new side of the business. That's why our valuation is so high. And that's the growth that we are intending to hit. So those, announcements about new revenue streams and new elements to your business model, I think they should be used very strategically. And you don't want to lay all of your cards out on the table up front. But if you do it more strategically, you will be able to do that cool tricks and fundraising strategies like that.
Okay, yeah, that's very, very helpful. And also with the KPIs for the funds, what do they look at specifically in regards to, is it more the client base of that there's gaining more traction? Is it the company valuation? What is it specifically that they're looking at to see what's a good fund, what's not a good fund?
You mean what is a good investment and what would be not a good investment for them?
No, in regards to the VC funds themselves, their basket, their portfolio, what are the KPIs they're looking at to see, okay, this is a good VC, this is a bad VC, so you can know exactly what member you would want to be in. If you want to be in this VC versus this VC, what KPIs would you say to lean towards in regards to navigating and calculating?
Yeah. So, this is where it gets more technical, and this is usually the KPIs that the VCs would be presenting to their LPs to basically deliver on what was the performance of the fund. So they've got TVPI, for example, which is total value to paid in capital. And that essentially demonstrates the overall performance of the fund relative to the amount of capital that they receive to it. So let's say if an LP invests in a fund, like if they've got like a $20 million fund, and then we are comparing to what was the actual performance of the fund and how much did they make in return, it would be a ratio of of what the fund has achieved. And why it matters to the LPs is important because they want to know exactly what was their own return on investment. Same as VCs invest in your startup and they want to know what's the return of investment. LPs invest into the VC funds and they also want to make sure, like that they are getting their the returns as well. Then some of the signals that you can watch out for when it comes to the fund's performance is, for example, if a VC fund has an exit, that is a really, really good signal. And this is something that they would be announcing everywhere on their LinkedIn, on their website, in the news. It's huge news. Whenever there is an exit. If they have like a really successful exit for one of their portfolio companies, chances are, when they exit, the VC gets paid out, the investor gets paid out. Chances are they made, like a good return on investment on it. And what that means is that their fund performance increases, and they technically would be able to have more capital to deploy as well into new startups. So generally, I would be looking for like a VC, let's say with 2 or 3 exits. If you can find that, that is fantastic. Yeah, that's like part of like the due diligence that you should be doing on the VC fund itself as well. Another metric that is quite common is the IRR, which is the internal rate of return. And that just basically shows the percentage return that is realized over the life of the investment of a fund. So basically, the higher the IRR, that means that the investment is performing well or is expected to perform well. And then if you are a seed stage investors are usually targeting at least a 30% IRR. However, again, this is not something really that could be found openly on VC websites. This is more what the fund managers and the GPs are talking about themselves in like their annual meetings, general meetings. And yeah, this is also part of the information asymmetry that exists between the VC side and the founder side.
Yeah. How quickly you think the VCs are in regards to waiting for you to generate profit with the startup? Is it 1 year? Is it year 2? Is it year 3? When is the expected time frame typically? Or does it depend on the industry, the type of product?
Absolutely dependent on the type of the industry and the product. So if you are in a capital intensive industry, let's say pharmaceuticals or biotech or huge elements requiring hardware, then I don't think specialist investors who know how your industry works, I don't think they will be expecting you to be profitable in year 1 or year 2. It's just simply not possible. And to be honest with you, even when I review pitch decks for SaaS products and software startups and so on, if I see a founder in their financial projections putting that they will be profitable from year 1 or year 2, that doesn't sound realistic to me. Because realistically, year 1 on your business, 12 months will fly by. They will fly by so quick. You will be building your product. Your biggest expense should be on product development, and trying to develop the actual features that your clients will want. You might get a wait list of users that want to use your product, and hey, you might even get some paying clients in that year. If you do in year 1, fantastic. But I don't think you will be able to reach the point of profitability where you will be able to cover all of your expenses and still make profit on top of that. Because usually in those early stages, whatever amount of revenues the business makes, usually the founders choose to reinvest it all into the business, to invest more into product development and so on. I would say most companies are able to reach profitability once their product is completed and around once they have product market fit.
Yeah. In regards to the marketing,
Mhm.
what do you think some of the best like strategies are? Do you think that the marketing should start super early during the pre-seed stage, or do you think that marketing should start a little bit later once the product gets around the MVP stage? Like, when do you think the
Hmm.
marketing should really start ramping up?
I actually would say as early as possible.
Mhm.
I don't think it's ever too early to get the word out there about your business and what you're building and what is it that you're doing. Even like as you as a founder, I'm a huge fan of, like building your own personal brand, which is something that I've done myself on
Yeah.
LinkedIn.
Mhm.
And I cannot count how many times it has been so useful to me in a sense that, like investors are reaching out to me. They would be sending connection request notes to me and they want to speak to me. And founders as well. It's just such a big accelerator
Mhm.
to, to be able to get more clients and do what it is that you want to do. So I would say marketing alongside product development are the most important cost categories in the early stages that you should be spending most of your money on. Usually, like the use of funds slide on in the pitch decks.
Mhm.
And there's always a pie chart that shows, like how many funds you will devote where. Some of the most successful raises and the clients that I worked with that raised successfully, the unifying element between them was that product development and marketing was their two biggest dominating cost categories on which they
Yeah.
were spending VC money. And that's what VCs want, because those two categories directly result in growth of the company.
Yeah.
You're building your product. Naturally, this is the growth of the company. You're spending your money on marketing and sales. This will result in more clients and this will result in more revenue. So that's why, especially VCs like those categories.
Hey bro, I'm just trolling is something that will not just challenge your perspective, but also touch your heart and soul. It's a book that defies convention, blending art and literature into a thought-provoking masterpiece. A reflective piece of provocative art that tackles societal constructs from angles you've never considered. Hey bro, I'm just trolling delves into the very essence of our existence. It questions the technology that surrounds us, challenges our notions of beauty, stares unflinchingly into the eyes of death, and questions the boundaries of freedom. It scrutinized the educational system that molds our very future. This book is a journey, an exploration of shared human experience, and it's a work of art that refuses to be confined by tradition. It's a canvas painted with words, a melody of thought, and a testament to the power of creativity in a world dominated by algorithms and data. Visit moonboycapitalventures.com and get your hands on Hey Bro, I'm Just Trolling today. It's not just a book, it's a movement. Now let's jump back into the show.
When you talk about building your personal brand, do you think that you can say you built a personal brand? Because in my case, like I've been growing my YouTube channel,
Yeah.
but my YouTube channel is something actually separate. It's more about travel. So I was wondering, do you think that you could cross-pollinize your personal brand with a startup that you're building in something separate, or do you think that you should just build something else separately? Like for instance, what I'm doing my podcast, I can overlap. There's overlap there where I can promote it to as well on my podcast.
I think the answer to this comes down to like literally depends how much time you've got on your hands and like how much you can devote to it. Because
Yeah.
um well, if you've got a travel channel, could you, for example, target digital nomads and people who are traveling but are also entrepreneurs? Could
Mhm.
they come on your podcast? Could you do that strategic overlap where growing one can help you to grow another as well? If you can find ways to do it, then yes, that's a good idea. But the audiences must overlap
Mhm.
in some way or another. Because if not, you just be building like one thing here and doing one other thing on the side. But if there are two completely different audiences, it could be hard to marry them up together.
Yeah.
One thing that I also wanted to say earlier when you asked me about the expectations of VCs and so on. So
Mhm.
when we talk about SaaS businesses, software as a service. And like these days, this is one of the most popular models that are out there. And it's a reason why it is the VCs and investors' favorite, because essentially on a software as a service model, the VCs can expect predictable and recurring revenues coming in monthly to the business. Usually, SaaS businesses should be aiming for about 80% gross margin and above. There's not that many expenses. And ideally, the metric that I really like is NDR, which is the net dollar retention. That should be over 100%. And this means that even without acquiring any new customers, ideally your business steadily grows year over year. And this would be basically stuff like upsells, upgrades, like additional things that the customers can purchase from you. And it's great because it is always easier to upsell to an existing customer rather than acquire a completely new one. So if your NDR is, some of the best SaaS companies out there, they have an NDR of about 140%. Which means that even if they do not secure any new customers, even if with 0 new customers, they will still grow their revenue by 40% year on year.
Wow.
And it's amazing because a high percentage NDR changes your outlook on your customer acquisition cost. It takes the pressure off of it. That also means that you do not have to worry as much about your customer acquisition cost payback period. Again, big pressure off. So the NDR really comes down to how well thought out your business model is and how smart you are with setting up your revenue streams. So going back to your example, like with the two different things, like marketing around the travel YouTube channel and the other one, could the YouTube channel be incorporated into the other business as one of its secondary revenue streams? Would you be able to make a link there, and could one be funneling the other? That kind of thing.
Yeah. Okay. Yeah, it makes sense. And where would you say that founders are struggling most when they're trying to raise capital? Is it that, they don't have their MVP quite worked out? Is it their pitch deck? Is it their pitch itself? Where do you see the most struggles with founders trying to raise at that pre-seed stage?
I think what I'm hearing from founders most often is lack of the network. And, every founder will tell me that, like they need more introductions to VCs, they need more access to investors. And I think that's valid. But I think what is also valid is mastering how you reach out cold to investors. And that is super, super important, because I genuinely think that the majority of cold emails out there these days are just crap. Yeah. They're too generic, and you're not really outlining why this investor should speak to you. If I reach out cold, and I did, by the way, and I did to the likes of A16Z and Sequoia and so on, and they replied, and I was targeting partners at the top level as well. And yes, they did reply. Usually when I do my cold email outreach, it could take me anywhere from about 20 minutes to even 40 minutes to do the research on one VC. So 40 minutes before I send a cold email outreach, even up to that. But you only need one yes. And, yes, you might spend a full week doing full-time cold email outreaches just to send out, let's say, 50 of them, right? Huge amount of workload. But if out of that 50, 5 of them will actually reply to you, and 3 of them will go into a meeting with you, and 1 will ultimately write you a check for 2 million, then it's very much worth it. So I'm of a mind that it takes time. Relationship building is definitely a long-term game, which is also a lot of founders find, the area of my work where I work with early stage founders and I help them understand the concepts of, what makes a VC-backed company and how to improve the chances. This is mostly suited for pre-seed and seed stage founders, because once you're at a Series A, once you've raised from some VCs already, chances are they will introduce you to their co-investors. Chances are they will introduce you to other VCs in their network. And that's when you're flying much, much, much easier. but it's the hardest to go from a pre-seed to seed and then to Series A. Once you're at Series A, you're usually like, oof, okay, it's now, like the access technically should be easier. And the Series A is like really a sweet spot for VCs to invest in, because it is early enough for them to, maximize the returns, but also late enough so that the startup has product market fit, they have some traction, they are usually revenue generating. And yeah, that's basically like the safest spot for them to invest in.
In regards to the price increase from the pre-seed to the Series A and so on and so forth, what do you think is a doable price increase? Like, do you usually increase the share amount from 10%, 20%? Like, what have you seen?
Do you mean on how much equity do founders give away?
Not in terms of how much equity, but say for instance, someone invested at the angel round for, basically nothing. And then they want to now sell at the pre-seed round for, let's say, 5 cents per share. And then they want to increase that to seed round to, let's say, like 15 cents per share. Have you seen that type of element in regards to that?
So that really depends, because usually, like, if someone invests at you at pre-seed or like a
Yeah.
seed stage, and let's say it's an angel investor, right? Let's
Yeah.
talk about that example. Yeah. So, usually they're locked in with you until you exit,
Got it.
unless you offer a secondary share option, which, they don't happen too often. One of the companies that I invested in, actually, they are doing an additional raise where existing investors can put up their shares up for sale on a platform where that raise is taking place. But again, this is not guaranteed. This is basically, I will get my money back only if there is another investor coming in that wants to buy those shares off of me. Or usually, most angel investors would wait until an exit event, or your IPO, and that's usually when everybody exits and everybody gets paid out. But yeah, the secondary sales options between pre-seed to seed or seed to Series A are not that common from my experience.
Okay. What about the vesting schedule?
Mhm.
Is there like sort of, okay, are you giving all the shares up front if you're in the pre-seed round, or what's the
No.
vesting schedule you usually look at?
So that depends. If you've got an investor coming in and they are investing in you and they are paying for the shares, then usually that what goes is that they receive all of those shares immediately, because they pay for them. Upon payment, makes sense. You get the money, they get the shares.
Yeah.
You can attach a vesting schedule to them, but vesting schedules are more popular when we talk about your co-founders or when we talk about your advisors, for example. And I've seen vesting schedules based on like 1 year vesting, sometimes even up to a 3 year vesting. However, I think 3 years would be hard to execute at a pre-seed level. So I think the industry standard would be about 1 year vesting, which basically means that, like your advisor or your co-founder and so on, they have to stay with you for at least 1 year before they accumulate all of those shares. The shares usually accumulate on a pro rata monthly basis. But also what founders do to protect themselves is that they would implement a cliff clause. So, a cliff can be put at 3 months, 6 months, or even at 12 months time. And that means that if the potential co-founder or advisor chooses to leave before the cliff, they lose all of the equity that has vested so far. So that's like a protection measure to ensure that your, let's say, co-founder stays with you for that 1 year pivotal time of your business, and only then the shares are allocated to him.
Yeah, and when you look at the different industries in which people are trying to raise funds for, where have you seen the most success? Like, is it more AI right now? Is it logistics? Is it the biotech? Because you mentioned it a little bit, but where did you say is the highest potential to get a raise within that pre-seed
Yeah.
round?
Well, it wouldn't be 2023 if we didn't mention AI.
Yeah, of
So
course.
at the moment, yes, AI is getting, like all the spotlight and all the attention. and it is definitely one of the sectors where it's the easiest to get an investment. I was reading an article from Sifted, and Sifted actually looked at the results from the last quarter of this year. And surprisingly, fintech funding has fallen down a little bit, whereas SaaS still remains very, very high. Enterprise software is coming to the forefront as well, and then health tech as well. And I think health tech, especially health tech and climate tech, are one of those sectors where they need a higher capitals to start with, but then the returns that they can deliver on are substantial.
Yeah. And if you're someone trying to join as a member of a VC, can you just break down a little bit of the process of how it works? Okay, I'm trying to join as a member of a VC. I'm in a VC now, and I would like to allocate some of my capital to this project. How does it work step by step, contractually? I think you have the SAFT and all these different sorts of elements too as well. Like, how does it work so I know my capital is a little bit protected, and people aren't going to try to run away with my capital?
That actually might be going outside of my area of expertise per se. Yeah.
Okay.
So I wouldn't know how to generally answer that question for you.
Yeah.
But are you talking about like self-investing the funds into your own startup?
No, like say for instance that I want to join, A16Z or one of these big Coinbase Ventures or something like that. Like, how would that process work in regards to, okay, I'm in the group now. How do I then raise the capital? Is there contracts involved? How does it actually get raised? And how does the vesting schedules work? How does all that stuff work once you're in these type of VC groups?
But you would be still joining the VC group as a startup founder and then just networking around with those VCs trying to raise capital?
No, this is just strictly as just an investor.
As an investor, so you would be seeking to join the VC. Okay. Well, the only processes that I know about is literally just straight, like joining in the VC as an employee, and working under their fund. But if you were to join a VC and then have that VC to invest in the company that you're running, it would probably need to check if there doesn't, breach any competition clauses or like insider kind of information, if you know what I mean. Because like if you are working for this and then your startup gets an investment. So if you were to seeking to do that, I would probably outline this proposition to a VC as early as possible in the earliest of conversations to actually gauge if this is something that they are able to do contractually, and if this is something that that would be even possible or not.
Yeah. Do you think your location sort of is a determining factor in regard to getting a raise versus not getting a raise of where your company is? Like if it's in Israel versus if it's in London versus if it's in New York, do you think that matters?
Yes, to some extent it does. So many of the VCs that I spoke to, they will have a geographical mandate attached to it. So UK-based investors like to invest in the UK only because of the SCIS and EIS benefit schemes. European investors generally invest across Europe. And then US investors, from what I've seen, they are the most likelihood to be investing globally. But investing locally comes with a lot of intangible benefits that the VCs are looking for, and that's like the knowledge of the local market, ability for them to help that portfolio company more with the networks that they are seeking to help them with, and so on. So the best way to know this would be probably to look up the VC's portfolio companies and see where they are based, and see if that's like a wider span of the different companies. And then if we're talking like huge VC firms with multiple offices worldwide, it's also very important that you reach out to the specific partner in the specific region in which you are in, because that will be the best fit and the best match for you to actually get a response and start a conversation there.
When you're building out your pitch deck, what would you say some of the main points of emphasis that you should have in your pitch deck when you're trying to pitch the VCs? Like, how should it look? How should it be structured problem, solution, MVP, and etc.
Yeah, absolutely. So I usually go with my pitch deck template, which I've posted about, by the way, on my Substack newsletter, and it's got 12 slides, and like going from an intro slide, then problem, solution, market size, business model, and business model slide usually includes revenue streams as well. Then competition, competitive advantage, go-to-market strategy. Go-to-market strategy is one of the ones that are very, very much overlooked, and yet they are so important. And then traction. If you do not have any traction, you can replace it with roadmap ahead. And then your financial forecast, your team slide, and lastly, the ask. J12 Ventures posted a really, really cool investor pitch deck template that I was checking out recently. And they also suggest that you should have the yes slide, which comes in one of the very first slides in your pitch deck. And this is basically stating a strong statement of why the time to invest in you is right now. Like, is it the certain industry dynamics that took place recently, and now it really comes down that the investor should invest now, or is it certain traction that you've accumulated? So I thought that was a really cool idea for a slide as well.
Once you've gotten the initial funding, do you think that it makes sense to add a sort of technical element to the pitch deck or sort of the expansive model of the white paper?
In the appendix, yes. And I would probably link it as an external link. And maybe just, like if you want like a separate slide for it, then I would link the white paper and maybe just put in like 2 or 3 main bullet points findings from that white paper. Because if an investor wants to dig in deeper into that, then they will. But at the same time, it doesn't eat away too much space from your pitch deck real estate.
Yeah. Okay. And when you're pitching, because I don't know how good you guys thought my pitch was, but I just want to know, just so I can get better and better at pitching. When you're pitching, what are some things you can say specifically in regards to how you should pitch, how long the pitch should be, what are the main things you should talk about, not read off of the freaking white paper or the pitch deck,
Yeah. So I think I would say the ideal time for the pitch length, I would say, is 3 minutes. And especially if you're going later on in front of the VCs and so on, and they have very, very limited time. I think 3 minutes is very crispy. And if you can deliver your full message in that 3 minutes, it's great. I've seen what I've seen founders do is that, they would conclude their entire pitch in 3 minutes. And then, like they would stop on the exit slide and say, that's the end of the pitch. I do have additional slides in the appendix. So if there's any portion of the pitch you would like me to dig in deeper, please let me know, and I will be happy to show the additional slides to answer your questions, which I thought was a really, really cool strategy. I would say also the energy that you bring into the meeting is so super important, because like an average VC founder relationship lasts longer than an average marriage. So it's very, very important that you get along, and you do want to get along with someone that you will be working with for that long time. So building those relationships, like bringing in a lot of energy to the meeting, being excited about your business is great. Do not come from a position of lack. If you come to the pitch meeting from a position of, we really need this money to build a product, we need this money to do this and that with your money we'll be able to this and that. No. If you can talk about, we've already had this many signups on our wait list, our customers are getting really excited about our product. I spoke with one of the customers yesterday who really liked the new feature that we are thinking to implement. Essentially, we want to be able to, to deliver all of those amazing things that our customers are already excited about. That's when you're coming from a position of traction and already having all of those amazing things that are happening for you. And the mindset that you're bringing in here is that I'm building something amazing. it already exists. Do you want to be a part of it or not?
Yeah.
Yeah, rather than, like, oh, it will be amazing, but only with your money, not with
Yeah, yeah, I understand.
it's a very, very subtle change. But when you're at a meeting, and when you're at a face-to-face meeting or a Zoom meeting, there's so many things happening subliminally, that even the slightest change in wording can play an impact.
Yeah, absolutely. And how much equity do you think you should set aside? How would do you think is the best structure? Say, for instance, you're just one single founder.
Mhm.
How much equity should you set aside for VC investing?
Okay, yeah. So that really depends on a stage. And I like this question because I also did a full deep dive into this on one of my newsletters.
Yeah.
So if you're starting out as a solo founder, ideally you want to create an option pool for employees, and that's usually 10%. It's pretty
Mhm.
standard. At the pre-seed level, you could get expected to get diluted anywhere from about like 10% to 20%. At the seed level, pretty similar. I would say 15% to even 25%. I've seen
What?
VCs, yeah, I've seen VCs asking for as high as 25% at the seed raise. I think it's a lot. And if they are asking for that, then I always say to founders that you should specify what comes with it. Not only how much you invest, but also, like, what support are you providing? How will you help us grow? How will you help us execute our roadmap? Because it's a very, very high ask for 25%. But I know of VCs that are asking for that. Generally, by the time you reach Series A, you and your co-founders ideally should still have the majority controlling ownership. So at least 51% between you and your co-founders at a Series A. If you do not have that, then whatever VC comes in at a Series A level, they might think that you are over diluted. Series A level, I think the averages is around 15% of equity that you could be giving away. And then Series B level, about 15% as well. Series C, you could maybe potentially push it down to like 12% or something, because that's when we're talking, like smaller slice of the pie, but it's worth
Mhm.
much, much, much more.
Yeah. So with Series A, what would you say if, say, for me and my co-founder, for instance, would be a good level in terms of threshold? Should you have 60% of the company, 70% of the company? What have you typically seen that works the best at the Series A level?
If you can still have 70% of your company at a Series A, I think that's a really, really good result. I think 60% is more common. But the more the better, really. But then again, this is where it comes to choosing your investor quite strategically, and being able to see, like, like what is worth what. If you've got like a really, really high profile name VC investing and like in your cap table, like, if at a seed stage level, let's say you give 22% to, let's say, Sequoia.
Yeah.
And then when you reach your Series A and you come to Series A investors and you say, we've got Sequoia on our cap table, chances are you will have a much easier time raising. And like it really depends on like what's your exit plan, because I've seen founders exit with like owning, just like one of the co-founders would own only like 5% of the company, but the
Mhm.
exit was substantial and they were still happy with that. So there is certainly a balance to be struck between how much equity to give away at each stage and how much you can afford to give away.
When you look at the co-founder dynamics, what would you say is a good equity split between the co-founders? Should it be, say, for instance, that there's the CEO and the CTO and they're kind of splitting the equity? Like, how would you say is a really good dynamic in terms of percentage splits?
Yeah. So one of my favorite topics, actually, because I was digging into that quite a lot. And so, for example, from the YC forum, which I've been browsing extensively, the general advice from like YC mentors is that if you've got a quite uneven split, let's say 80-20 between two co-founders, that would raise eyebrows for them,
Mm.
because they would be thinking, like how is that 20% level co-founder actually incentivized to work with you and so on. I think personally, if you have two co-founders that are contributing pretty much the same in terms of how much work they do, and if they are both full-time on this, then I think their equity split should be pretty much equal. Generally 49 to 51 is best, because you still want one of them to have that controlling ownership. It's just easier for decision making. And I think the standard advice coming from YC is that usually a co-founder level would be someone who has like 30% or more, maybe like 25% or more. Anything less than that is like, I would be thinking, like, it would immediately make me think like, oh, how else are you incentivizing that person? Are you giving them a salary if they do not have that much equity? That's just like the natural line of thoughts that follow. And you can give your co-founders more, because then you also have to remember that you and your co-founders as well will get diluted over time as new investors are coming in onto the cap table. So some co-founders might ask you for anti-dilution clauses in your vesting agreements as well, which is where like your options pool might come into play. So like at one point you might need to top them up, so that they don't lose out on their equity as much. But it's tricky, especially at the pre-seed stage, because no matter how good your idea is, it is just an idea. And I've seen enough businesses pitching to me to know that whatever you're pitching to me right now, in 6 months, chances are it will be a completely different business.
Yeah, I know we spoke a little bit before this, about that. Yeah, I've already started tweaking my idea already.
yeah, which is something that happens, and that's absolutely fine. But it's the people who will stick by you in this process. So like if I was to go into business, if I had a business idea and I was to like get one of my friends to do it with me, who are like fantastic in business, I would be probably offering them half split on this one, even that the idea was mine. But if it's just an idea, and let's say a pitch deck, and I don't have any traction yet, no signups, no MVP, then I would be thinking 50-50.
Yeah. And what about salaries? How does that work? So once you get the initial funding, let's say at the seed round,
Yeah.
or how do you look at it in regards to how much should I pay myself as a CEO versus, the CTO? Like how much you think that the salary should be, depending on how much obviously you get funded, but how much you think it should be?
Yeah, so this is a very, very much gray area, unfortunately. And every investor that I spoke to and that I've heard from founders that they were talking to, they would say like different guidelines. There is this really cool website, and I've just found the link, and I don't know if you will be able to link it in the show notes. But it is a website that shows from 2023 what are the salaries and equity given based on a title. So, for example, we can see that an example from late 2022, someone for their CTO, they offer them a 100K salary, that's in US dollars, by the way, and 20% equity. And that CTO was based remotely. He came into the startup at a pre-seed stage. And the size of the company was between 1 to 10 employees, and the valuation of the company was 12 million. In smaller range valuations, so for example, we can see there's one that is valued at 1 million. The equity given to a lead software engineer was 5%, so significantly lower, and then 100K salary. I don't know how a pre-seed company can afford a 100K salary, but hey, it could be, like previous founders' funds, bootstrapping, previous exits. It is truly, truly a lucky position to be in life if you've had a previous exit, and then you can use it to start a new startup.
Yeah, it makes sense. Is having more than two co-founders a red flag?
No, I wouldn't say so. I think 2 and 3 co-founders is usually investors' favorite, at
Yeah.
least from the conversations that I've had and from what I've been hearing. Solo founders are unfortunately slightly disadvantaged because a lot of investors might think that this is quite risky. But 2 co-founders, 3 co-founders, 3 is perfect usually.
And the suitable amount for a raise, I don't know if you already previously touched on it though, in regards to the amounts from the pre-seed all the way down to the Series A, the Series C. Did you discuss that
yeah.
already? I don't know.
No. I think we talked about dilution and valuations and so on. But no, the amounts raised, yes, we did.
Yeah.
So I'll touch on the valuations. So what we're usually seeing at the pre-seed level is that the valuation could range between 1.2 million to about 2.5 million, and we're talking pre-money. Then at the seed level, that is usually where you can go up to about 5 million to even up to 10 million pre-money. Series A is, I think the average given by Sifted is around 18 million to 25 million pre-money valuation. Series B is where it really goes up. So that's when you usually should be targeting 65 million, 80 million valuation. And, this is adjusted to the numbers and figures from this year. So 2023 statistics. And then Series C, let's say about 200 million, sometimes even up to 300 million. And then a sizable exit to me would be anything above 300 million and above.
Okay.
Yeah.
Makes sense. Eva, thank you so much for coming on.
Thank you.
This is super valuable. I appreciate you. Where can people find you on the internet?
LinkedIn is best, and LinkedIn was where I put out everything, so they will be able to find, like most information there on the early stage incubator, Block Dojo. We are currently accepting applications still for the next cohort, where I know I will see you as well. And then also in my profile, we've got linked the Discord community that I am running alongside as well, so people can sign up, and we do have a free version as well if someone wants to check out a free version, and that's where we share all the resources.
Okay, I'm going to leave links down below, guys. This concludes this episode of the Mooncast, man, and peace. As official sponsors of the PodSafe Music Group, I bring to you Yakoyo by Scott Geary.
Scott Geary, she's a good girl from the uptown side. She got a pretty face and a big backside. I see a real sharp guy from the downtown side. I just wanna jump and slide. On to the next, baby, oh yeah, go yo. Baby, oh yeah, go yo. Tonight is the night, I'm on my Jekondo. I'm on my Jekondo. On to the next, baby, oh yeah, go yo. Baby, oh yeah, go yo. Tonight is the night, I'm on my Jekondo. I'm on my Jekondo. I'm very eager like my producer to chop your body like a samosa. I wait for you to come over. Yeah, my side, baby, come closer. Cause I rap it to a lot now. Your pictures, they turn me on. Girl, I know if you wait no more. I just want a sweet love to you. On to the next, baby, oh yeah, go yo. Baby, oh yeah, go yo. Tonight is the night, I'm on my Jekondo. I'm on my Jekondo. On to the next, baby, oh yeah, go yo. Baby, oh yeah, go yo. Tonight is the night, I'm on my Jekondo. I'm on my Jekondo. Enter your DM 2 months ago. When you just work for IGO. The body a joke, but lies me up. When you tell me to add it, many things I want to do to you. Give my location and send to you. Let me know when you come me through. Face my private jet to come get you. Cause I rap it to a lot now. Your videos they tell me Girl, I know if you wait no more. I just want a sweet love to you. On to the next, baby, oh yeah, go yo. Baby, oh yeah, go yo. Tonight is the night, I'm on my Jekondo. I'm on my Jekondo. On to the next, baby, oh yeah, go yo. Baby, oh yeah, go yo. Tonight is the night, I'm on my Jekondo. I'm on my Jekondo.